Well, we did our last video over an email that we had been receiving a couple times from clients calling for a 70% market decline in November. Well, that did not happen, but it's very clear we're in a market correction type mode. And so suddenly, as we've talked about many times, that fear emotion is really starting to build up, and concern of, how far off, or should I make changes? What should I do? Well, the number one thing is, we typically don't want to make changes to an investment strategy just because we're in a bear market or market correction mode. We've considered these types of environments. If you retire at 65 or somewhere near that, you could expect to maybe live 30 years in retirement, which if we have a bear market every 4 to 6 years and market corrections on average one every 2 years or so, we can expect to go through lots of these types of environments as an investor. So what might dictate a change to someone's strategy? Well, it's really planning based. Has there been an income change? Has there been an expense change? Has the needs over the next 3, 4, 5, 6 years changed such that we don't have as much time to ride out these types of markets? Those are the big things or a health change would be another one, that might dictate a strategy change, and we need to know about those. So if you've experienced any of these and we haven't talked about it, we need to. So give us a call, send us an email, let us know if you're going through these types of changes so we can go back and look at the investment strategy to make sure it's still appropriate and designed to meet those goals. So what's the big news right now? Well, the big news right now, of course, is it looks like the trade talks have improved some with China, and the market we were hoping would suddenly find a more comfortable space when that happened, but it didn't, because suddenly now interest rate talks are back in the picture. Well, what happens? I mean, why does interest rates have such an effect? Because interest rates affect everything about the economy, from how much a consumer has to spend in order to maintain their lifestyle. When interest rates go up, obviously those expenses go up, from debt payments because interest rates are higher, from the cost of goods and services being higher because corporations or businesses, it costs them more to borrow money, so they're passing that off to you in terms of higher prices as a consumer. And if revenues drop from a corporate standpoint and a publicly traded corporations, the stock price would presumably drop as well. So interest rates make investors very nervous. However, we need to get back to normal rates too, and the Fed has made that clear that they're not all that concerned with the stock market. They're more concerned with getting rates back to normal levels and controlling potential inflationary issues down the road. So I think as an investor, we should set our expectations appropriately and expect them to continue moving forward with their interest rate goals. And certainly the market is going to react probably in a way it has the last 3 or 4 interest rate changes. So this market might get worse before it gets better. But it hasn't come without a plan. We know that these markets are going to happen. We've talked about that in a lot of these videos. But again, if you've had changes in your financial situation, from health to expenses to income, let us know. We need to sit down and talk about it and build a good long-term game plan. Just a quick market update. The S&P 500 so far this year, America's 500 largest companies, it's down around 3% year to date right now. Not to make light of what we're experiencing, but if you would have told us back in 2008, 2009, the market would only go down 3% for 1 year, and again, this could get worse before it gets better, we'd all taken that. So it's about perspective in some ways. The international markets, often measured by the International EFA Index, which looks at corporations internationally, how have they done? Well, it's down around 13, almost 14% so far this year, so much worse than the U.S. market. So when you're globally diversified, certainly to build an efficient portfolio, you do want to own international stocks, but typically in a most efficient portfolio, because of the risks they carry, it's going to be a lot less international stocks than you might have U.S. domestic stocks in a traditional efficient frontier type portfolio. So hope you're having a great week. Hope you're having a good Christmas season. Give us a call, and certainly we'll see you in a couple weeks.